If you are a complete beginner and you want to learn how to trade in 2026 and how to use algorithms to make your trading even more profitable, this is the only video that you need to watch. I am going to give you a complete beginner's guide, everything from what trading is to how algorithmic trading works to the exact strategy that I used to make over $800,000 in the markets last year, and I'm giving you all of this for free. Now here's why you need to watch this entire video. 95% of traders fail because they're doing it the hard way. They're sitting at their desk all day, manually clicking buy and sell, dealing with emotions, missing setups. That's not the way. The new way, algorithms. Every hedge fund, every bank, every institution is using algorithms to trade. And in 2026, if you're not using algorithms, you are already behind. So here's what I'm going to show you in this video. First, I'm going to teach you the fundamentals of trading, the basics, how the markets work, how people actually make money, and why most traders fail. Second, I'm going to break down algorithmic trading, what it is, why it's 10 times better than manual trading, and how you can use it to build consistent income without being glued to your screen. Third, I'm going to teach you the exact strategy I learned from my godfather, who was a trader at Goldman Sachs for over 30 years before he retired. This is the same liquidity-based framework the big banks use to move markets, and I'm going to show you how to automate it. Finally, I'm going to show you proof. Back tests, live trades, live broker logins, real results so you can see that this actually works. By the end of this video, you are going to have everything you need to get started with algorithmic trading the right way. So if you're serious about this, grab a notebook, turn off your distractions, and let's get into it. All right, let's start with the absolute basics. What is trading? In the simplest terms, trading is buying and selling something to make a profit. That's it. You buy something at one price, you sell at a higher price, and you keep the difference. Or in more advanced trading, you can actually profit when price goes down, but we'll get to that a little bit later. Now, when most people think of trading, they think of the stock market. They think of buying shares of Apple or Tesla and holding them for years like this, right? You buy right here in 2023 and you hold until 2025. That's not trading. That's investing. Investing is when you're holding something for the long term. Trading is a little bit different. Trading is short term. We are talking about buying and selling something within the same day, sometimes within the same hour, sometimes even within the same minute. We're not trying to predict what's going to happen next year. We are trying to understand what's going to happen in the next few hours. And here's the beautiful thing about trading. You can make money whether the market goes up or down. If you think the price is going to go up, you buy. We call this going long. If you think the price is going to go down, you can sell. We call this going short. This means that even in a crashing market, traders can still make money. Now let me show you why trading is so powerful compared to investing. If you look at the stock market over the course of a year, you might see 10%, 20%, maybe 30% gains if it's a really good year. That means if you invested 10 grand at the beginning of the year, you'd have 13 grand at the end of the year. That's great if you're dealing with a lot of money, but if you're trying to build wealth from a small account, you'd have to wait an entire year just to make 3 grand. But here's where it gets interesting. Let me zoom into just one day. Even in a single day, the market moves up and down a ton. If we're able to catch these moves, buy here, sell there, we can make that same 30% not in a year, but in a single day or even in a single hour. That's the power of day trading. Instead of waiting a year to make 30%, we can make that in a day by catching these intraday moves. And if we can do that consistently, we're not just making 30% a year, we're making 30%, 50%, or 100% or more per month. That's why most people get into trading, because the potential is truly massive. Now, before we go further, you need to understand that there are different types of trading and you need to figure out which one fits your personality, your goals, and your lifestyle. Scalping. This is when you're in and out of trades for seconds and minutes. So for example, if I took this trade right here and I caught 20 points, this would be a scalp because you can see that I entered this trade at 10:55 and I got out of this trade at 11:15, right? Minutes. Day trading. This is a little bit longer than a scalp. This is when you open and close all your trades within the same day, right? Day traders are typically in trades anywhere from 15 minutes to a few hours. So this same trade could actually be a day trade if I entered here, but decided to exit at around 3 p.m. instead of a few minutes later. Swing trading. This is when you hold trades for multiple days or even for a few weeks, right? So if I entered this trade on Thursday and I exited on Friday, that would be a swing trade. Position trading. This is basically long-term trading. This means you're holding positions for weeks or months. This is much closer to investing than trading. For this video, we are going to focus on day trading because that's where algorithmic trading really shines. You can capture intraday moves, you can trade multiple times a day, and you can automate the entire process. Now, before we go any further, you need to understand how markets actually work. Because if you don't understand this, you are going to get lost very quickly. Markets are driven by supply and demand. That's it. When there are more buyers and sellers, the price goes up. When there are more sellers than buyers, the price goes down. It's really that simple. Think of it like an auction. Let's say you're trying to sell a car. If 10 people want to buy your car, they're going to start bidding against each other and the price is going to go up. But if nobody wants your car, you're going to have to lower the price to get someone to buy it. The market is the same way. The market is a constant auction between buyers and sellers. When there's high demand for an asset, the price goes up. When there's low demand, the price goes down. Now here's where it gets very interesting. Markets don't just move randomly. They move based on where the most orders are clustered. And this is where institutional traders, the big banks, the hedge funds, the Goldman Sachs of the world come in. These institutions don't trade like retail traders. They don't just click buy and sell based on how they feel. They look at where the most orders are and they engineer moves to these levels to fill their massive positions. Here's a simple example. Let's say there's a key level at 5,000 on the S&P 500. Above that level, there are thousands of buy stop orders from breakout traders. Below that level, there are thousands of stop loss orders from long traders. The institutions know this, so what do? They push price to these levels to trigger all of these orders. They're essentially hunting for liquidity, and this is the foundation of the strategy that I'm going to teach you today. But first, you need to understand the basics. All right, so what are you actually trading? What assets can you trade? There are a few main markets. Let's go over them. Stocks. These are shares of company like Tesla, Amazon, Apple. Stocks are awesome, right? Stocks are great if you are trying to invest for the long term. If you have under $25,000, you have to follow something called the pattern day trading rule, meaning you cannot take more than 3 day trades per week, meaning trading stocks is going to be pretty hard for somebody if you have under $25,000. Forex. This is the foreign exchange market where you're trading currencies. For example, this is the Japanese yen against the Great British Pound. Forex is the biggest market in the world with trillions of dollars traded every single day. I think that Forex is a great option, but unfortunately for me and for any of you guys who are in the US, we are very limited when it comes to trading Forex, so I don't trade Forex. Futures. This is what I trade, so obviously I love futures. This is gonna sound a little bit complex, but stay with me, I promise you it's very easy. Futures are contracts to buy or sell an asset at a future date. The most popular futures contracts are the S&P 500 futures, ES, the NASDAQ futures, NQ, and commodities like gold and oil. Futures are what I primarily trade, and they're great for day trading because they're highly liquid, they move fast, and there's lots of regulated brokers that are trusted in the United States that we could use to trade futures. 4 is crypto, such as Bitcoin. I love crypto, but personally, I think that crypto is much better for investing, and trading crypto is ridiculously hard, so we're gonna avoid that in this video. Now, the strategy I'm going to teach you works across all of these markets. Once you understand the core principles, you can apply it to stocks, Forex, futures, crypto, it doesn't matter. The market structure is the same, but I recommend you use the strategy on the S&P 500 futures because that's what I do. So if you want to follow along with exactly what I'm doing, that'll be the easiest way to do it. All right, now let's talk about how to actually read a chart, because I'm gonna be really honest with you, if you cannot read a chart, you can't trade. And a lot of you guys cannot read charts. So let's get into it. When you pull up a chart, you are looking at price movement over time. The vertical axis, right, so this right here, the up and down, for anybody who doesn't know what vertical means price. The horizontal axis is time, right? So we are simply looking at what is price doing over time, right? You can see that price has been moving up over the last few hours. Now, there are different ways to display price movements, but the most common, and the one that we are gonna focus on today, is a candlestick. A candlestick shows you 4 pieces of information. This is very, very important because a lot of people mess this up. Before we actually get into this section, I want to show you guys my trading view settings so that you guys can have your chart look just like mine, so you just have a nice visual thing to look at. And I think that my chart settings, I'm a little bit biased, but I think they're really good and they're really helpful. So what we're gonna do is we're gonna double click on a candlestick and we're gonna turn the body and the borders on the left side blue. And then the wick is gonna remain black and the body is going to remain black on the body and borders. The reason we are doing this is because red and green are very emotional colors. If any of you guys have traded or even been to a casino, you'll know that red means loss, green means win. So when we have that on our chart, that can actually cause us to be a little bit emotional as traders. So that's why I like to change my settings around to have them look like this. I also have the back, right, to the background as gray, which I think just looks nice. I have had these settings up the last 5 years and I've made quite a bit of money using these specific settings, so I can promise you that they work. You don't have to do that if you don't want to, but I highly recommend that you make your chart settings look like mine for this next segment. So now that you've done that, we're going to go into a candlestick and talk about every single part of the candlestick. So let's choose this buying candlestick right here. So the first thing we have is the open. So the open is the bottom of the body of the candlestick, right? This is called the body of the candlestick. The wick is this black line, but the body is the open. The open simply means where price started. So on this candlestick, right, this is a 5-minute candlestick. Price started right here, and then 5 minutes after, it closed right there. So the close is the top of the body. The low is the lowest part of the wick. You can almost think of it as like, if you've ever seen a candle, the wick is where you light the flame, and the body is kind of like the flame of the candle. That's how I like to think about it. The high is the highest point of the wick. Now, this is the important part, and this is the part that people mess up. On a selling candlestick, so on a black candlestick where price goes down, the open is actually the top because price started higher and ended up lower, and the close is actually the bottom. The wick stays the same. This is still the candlestick high. This is still the candlestick low. These time frames up here show you how much time a candlestick represents. So if I go to the 1 minute, you'll see that we have a lot more candlesticks. If I go to the 1 hour, you'll see that we still have a lot of candlesticks. But if I go to the daily, the weekly, or the monthly, you'll see that things start moving pretty fast, right? Like this is, 5 years ago. So every candlestick right here represents a month. So just to recap, guys, I am now on the monthly chart, meaning each candlestick is showing us a month of price action. Now, if I go on the weekly, week of price action. Daily, day of price action, right? I know you guys get the point, but I'm just showing you guys this. 4 hours of price action, right? And it goes all the way down until 1 minute. As a day trader, I primarily look at the 15-minute and the 5-minute candlesticks. These give me enough information to make decisions without getting lost in the noise of the 1 minute or the 3-minute chart. Now, why is this important? It's important because the patterns you see on the charts are what give you your trading signals, and we're going to talk about those patterns later in the video. All right, so how do you actually make money trading? It's simple. You enter a trade at one price and you exit at another price. The difference is your profit, or hopefully not, but potentially your loss. Let's say you buy one contract of ES at 5,000 and you sell it at 5,010. That's a 10-point move, right? On ES, every point is worth $50, so you just made $500 in profit. Now here's the key. You need to risk less than you make. This is called a risk to reward ratio. If you're risking $100 to make back $300, that's a 1-to-3 risk to reward ratio, meaning even if you only win 50% of your trades, you're still profitable. Let me show you the math. Trade 1, risk $100, make $300, win. Trade 2, risk $100, lose $100, loss. Trade 3, risk 100, make 300, win. Trade 4, risk 100, lose 100, loss. So in total, you risked $400, but you made $600. You won 50% of your trades, but you're still up $200. That is the magic of trading with a good risk to reward ratio. You don't have to be perfect. You just have to make sure that when you win big. And when you lose small. And this is exactly what the strategy I'm going to teach you is designed to do. We are targeting 1-to-3, 1-to-4, sometimes even 1-to-5 risk to reward ratios, which means we can lose more than half of our trades and still be profitable. Now let me talk about risk management because this is where most beginners fail. Risk management is the most important part of trading. You can have the best strategy in the world, but if you don't manage your risk properly, you're gonna blow your account. I can guarantee that. Here are a few rules that I follow and that I recommend you follow if you wanna make sure that you actually keep your money. Rule number 1, never risk more than 1 to 2% of your account on a single trade. Percent, not dollars. If you have a $10,000 account, you should never risk more than $100 to $200 on a single trade. This way, even if you have 10 losing trades in a row, you're only down 10 to 20%. You can recover from that. But if you're risking 10% per trade, you have 10 losing trades and your account's gone. Rule number 2, always use a stop loss. A stop loss is a predetermined price where you exit the trade if price goes against you. This prevents you from taking catastrophic losses, and in my opinion, you should always have a stop loss. This is not up for negotiation. Rule number 3, let your winners run. Most beginners cut their winners way too early. They make $50 and then they get scared and start taking profit. But then their losers go to their full stop loss of $100, so they're winning 60% of the time, but still losing money because their winners are smaller than their losses. Don't do this. Let your winners run to your targets. Rule number 4, and this is a big one, do not revenge trade. I put it in all caps because it's important. If you take a loss, don't immediately jump into a trade trying to make it all back. This is emotionally taxing, and this is how you blow your account. You should be taking a little break, and you should be relaxing and journaling and understanding what you did wrong so that you can understand how to not make that same mistake in the next time. These 4 rules will save you more money than any strategy ever will, so follow them. Manual trading versus algorithmic trading. Manual trading is exactly what it sounds like, and you're probably already familiar with it. It means that you're sitting at your computer, manually clicking the buy and sell button, watching the charts, analyzing the market, and clicking buy and sell by yourself. This is how most people start trading. This is how most people trade. They learn a strategy, they watch the charts, and then they execute trades manually. But here's here's the thing. Manual trading can be profitable. I was a profitable manual trader and I still am, but manual trading has some serious limitations, and there's a reason that I'm shifting towards algorithmic trading. The first limitation is that you have to be at your desk, right? There's no ifs, ands, or buts. You do. If you're manually trading, you have to be watching the charts. You can't go to the gym, you can't go on vacation, can't spend time with your family during certain hours, because if you're not watching, you are going to miss setups and you are going to lose money. I used to wake up at 6:30 a.m. every single day and sit at my desk until around 3 or 4 just staring at charts. I was making great money, but I had no life. I was trading one job for another. And here's the worst part. Even when I wasn't at my desk, I was always thinking about the markets. I'd be on a date, I'd be on a dinner with my family, and I'd be checking my phone, I'd be on vacation looking at charts. I could not turn it off. It was like an addiction. The second limitation, you are emotional. Even if you think that you're not, you are, because you're a human. So even if you have a profitable strategy, you're gonna hesitate on entries, you're going to cut your winners too early, you're going to revenge trade after a loss, and your emotions are just gonna get in the way. I cannot tell you how many times I had a perfect setup, but I hesitated because I was scared of losing. Or I took a loss and immediately jumped into another trade to try to make it all back, and then I lost again. Sometimes I'd be up $2,000 on a trade and I'd get scared and take profit early, only to watch it go to what would have been a $5,000 winner. These are the emotional mistakes that cost you money. And no matter how disciplined you are going to make these mistakes. Limitation 3, you're gonna miss setups. The market does not care at all about your schedule, your life, or anything that you have going on. Setups can happen at 2 a.m., setups can happen on weekends, on Sundays, and if you're manually trading, you are going to miss a lot of opportunities. Let me tell you about the exact moment that I realized I could not do manual trading forever. This was about 2 years ago, and I was trying to trade London session, which opens at 3 a.m. my time. I had been seeing some great setups during that session, and I decided that I couldn't miss them. So I set my alarm for literally 2:58 a.m., and I woke up, I made some coffee, I sat at my desk, and I was absolutely exhausted. My eyes were burning, but I was determined to catch the setup. I waited for around 2.5 hours just staring at the charts, waiting for my setup to form, looking at my levels. And then at around 5 a.m., I just couldn't keep my eyes open anymore. I told myself I'd close my eyes for a little, nap, and I ended up falling asleep. And then I woke up at 7 a.m. Eastern Standard Time to see that the exact setup I was looking for had played out, but I missed it, and I missed what would have been a $10,000 winner, clean entry, clean exit, perfect 1-to-4 risk to reward. But I was asleep. I literally was not awake when the setup was playing out in front of my eyes. And that was the moment that I realized I cannot do this forever. I can't be awake 24/7. I can't spend every single morning looking at the charts. The strategy worked, right? I knew that. The data proved it. But I was the weakest link in my own system. And that's why I made the decision to automate it. So what is algorithmic trading? Algorithmic trading is when you code your strategy into an algorithm and the algorithm executes the trades for you automatically without you having to intervene. Instead of sitting at your desk watching charts, you deploy the algorithm and it trades 24/7 without you. It never sleeps, it never gets emotional, and it doesn't miss a setup. Now, when most people hear algorithmic trading, they think it's super complex and they think that you need to be some math genius, but that's just not true at all. Here's the reality. Algorithmic trading is just taking a rule-based trading strategy and automating it. If your strategy is buy when the price breaks above this level, sell when it hits the target, then an algorithm can do that for you. You don't have to code it yourself. Or you can hire a developer to code it for you. Or you can use platforms that make it easy to build algorithms without coding. The point I'm trying to make is that if you have a profitable strategy, you can automate it. And once you automate it, everything changes. The first benefit is that you get your time back. The algorithm trades for you. You don't have to watch the charts. You can go to the gym, you can travel, you can spend time with your family. You just check in once a day to make sure that everything's running smoothly. I wake up now, I check my algorithms, I see that I've made 2, 3, maybe even $5,000, and then I go live my life. That's it. 15 minutes of work and then I'm done for the day. The second benefit is that you remove emotion. The algorithm doesn't care if the last trade was a winner or a loser. It doesn't hesitate, it doesn't revenge trade, and it executes the strategy perfectly every single time. There's no fear, there's no greed, there's no second guessing, it just follows the rules. Benefit 3, you never miss a setup. The algorithm is always watching. It trades 24/7. It catches setups on 2 a.m., on Sundays, while you're sleeping. You never miss an opportunity. That $10,000 setup that I missed at 4 a.m., my algorithm would have caught it. And I would have woken up to see profit in my account. Another benefit is that you can scale. Once you have a profitable algorithm, you can run it on multiple accounts, multiple time frames, all at the same time. You can't do that manually. I currently have my algorithms running on 5 different accounts. They're all trading simultaneously 24/7. I couldn't do that manually even if I wanted to. Now here's something most people don't realize. Every major institution, hedge fund, or bank is using algorithms. Renaissance Technologies is the highest performing hedge fund in the history of hedge funds. The Medallion Fund, which was run by Renaissance Technologies, achieved an average of 40% returns per year. Their highest return was almost 100% in a single year. Hedge funds, banks, they're all using sophisticated data-driven systems to trade, and they haven't been manually trading for decades. In fact, it's estimated that over 70% of all trading volume in the stock market is done by algorithms, not humans, algorithms. Why? Because algorithms are faster, more consistent, and more profitable than humans. When you're trading manually, you are competing against these algorithms. You're trying to make decisions in seconds while algorithms are making decisions in milliseconds. It's like trying to race a car on foot. You're gonna lose. But here's the good news. Algorithmic trading is no longer just for institutions. It's now accessible to retail traders like you and me. You can build your own algorithms, or you can use pre-built algorithms, and you can compete on the same level as the institutions. This is the future of trading, and if you're not using algorithms in 2026, you are already behind. Now let me tell you why most traders fail. And this is important because if you understand this, you are going to avoid the mistakes that 95% of traders make every day. The first reason they fail is that they don't have a strategy. Most people start trading with zero plan. They watch a YouTube video, they see somebody make money, and they think, I can do that. So they open up an account, they start clicking buy and sell, and they literally have no idea what they're doing. Trading without a strategy is just complete guessing. You might as well go to Vegas. You might win a few trades, but over time you're gonna lose because you have no edge. You have no mathematical data that proves that you're profitable over a long period of time. So you're just guessing. Second reason is that they can't execute their strategy consistently. Even if they have a profitable strategy, most traders cannot execute this strategy consistently. They hesitate on entries, they move their stop loss, they cut their winners too early, and they revenge trade. This is the emotional side of trading, and it's what kills most traders. They know what they're supposed to do, but they can't do it consistently. I've seen traders with profitable strategies blow their accounts because they couldn't follow their own rules. They'd take 5 perfect trades, make money, and then they'd take 1 emotional trade and they would lose everything. Reason 3, they simply don't have the discipline and willpower to stick with it. Trading is hard. I'll tell you that right now. You are gonna have losing days, you're gonna have losing weeks, you might even have losing months. And most people quit the second that things get difficult. They blow their account, they get frustrated, and then they give up. They never even give themselves enough time to actually learn and improve. Reason 4, they overtrade. Most beginners think that more trades means more money, so they take on every single setup they see, even the low probability ones. And they end up losing money on trades they shouldn't have even taken. Reason 5, they don't manage their risk. They risk too much per trade. They don't use stop losses, and they blow their accounts in a week. Now here's how algorithms solve pretty much all of these problems. Problem 1, no strategy. An algorithm forces you to have a strategy. You can't code an algorithm without defining exactly what you're trading and why. So if you're using an algorithm, you automatically have a strategy. Problem 2, inconsistent execution. An algorithm executes your strategy perfectly, every single time. No hesitation, no emotion, no mistakes. It does exactly what it's programmed to do. Yes, you can still have losses, but you'll be profitable over time if you're using a strategy that's profitable. Problem 3, no discipline. An algorithm doesn't need discipline. It doesn't quit, it doesn't get frustrated. It just follows the rules and executes the strategy consistently every single time. Problem 4, overtrading. An algorithm only takes setups that meet your criteria. It doesn't take random trades. It doesn't overtrade. Problem 5, poor risk management. You program your risk management into the algorithm and it never risks more than you tell it to. It always uses a stop loss and it follows the rules perfectly. This is why algorithmic trading has such a massive edge over manual trading. It removes the human element, which is the weakest link in the system. All right, now I want to share the story of exactly how I learned my trading strategy because it's important context for understanding why it works so well. My godfather was a trader at Goldman Sachs for 30 years. He started in the 1980s, back when trading was done on the floor, and he worked his way up to becoming one of their senior traders. When I was in my early 20s, I told him I wanted to learn how to trade, and he said something I will never forget. Most retail traders are trying to predict the market. That's the wrong approach. You don't predict the market, you follow the money. He explained to me that the big banks don't look at charts the way that most retail traders do. They don't care about support and resistance, they don't care about indicators. They look at one thing, liquidity. Where are the most orders? Where are the stop losses? Where are the breakout orders? That's where the money is, and that's where they move price. He taught me that if you're going to understand where the liquidity is, you can predict where price is going to go. Not because you're predicting the future, but because you're following the institutional order flow. And that's the foundation of the strategy that I'm about to teach you. All right, now let's get into the strategy itself. This is the strategy that my godfather taught me, and it's the foundation of everything that I do. The entire strategy is built around the one concept that I just told you, liquidity. So what is liquidity? In simple terms, liquidity is where the most orders are clustered in the market. Think of it like this. You're at an auction and there's 100 people trying to buy the same item. That's a high liquidity area. There's a lot of interest, a lot of orders, and a lot of activity. In the market, liquidity pools form at specific levels, and these levels are the London session untested highs and lows, the Asia session untested highs and lows, the New York session untested highs and lows, and the first 15-minute candle from 8 to 8:15 a.m. Eastern Standard Time on the 15-minute time frame. So why are these levels important? Because this is where retail traders place their stop losses and their breakout orders. Above the highs, you have all of the breakout traders with their buy orders, and below the lows, you have all of the long traders with their stop losses. The big banks know this. They engineer moves to these levels to trigger those orders and fill their own massive positions. My godfather explained it to me simply. Banks don't look at charts the way retail traders do. They look at where the most orders are, and they move price to those levels to get filled. Our job as traders is not to fight the banks. It's to trade with them. We want to identify these liquidity levels, and we want to trade the reactions to these levels. And that's exactly what my strategy does. Now, before I show you the setups, you need to understand the session times, because liquidity forms around these sessions. There are 3 main trading sessions that I focus on. The first session is the Asia session. The Asia session opens at 7 p.m. Eastern Standard Time and closes at 4 a.m. Eastern Standard Time. This is when Tokyo and Sydney are trading. Asia session usually is a little bit quieter for ES futures and has less volume. The London session. This opens at 3 a.m. Eastern Standard Time and closes at 12 noon Eastern Standard Time. This is where London and Europe is most active, and this session is usually a bit more active than the Asia session, and it sets the tone for the day. New York session. New York session starts at 8 a.m. Eastern Standard Time, and then the stock market opens at 9:30 a.m., which is when the volume starts to come in, and then it closes at 5 p.m. Eastern Standard Time. The New York session has the most volume, and it's the best session to trade in if you are trading futures, which we are. Now, the most important times for trading are 8 to 8:15 a.m. Eastern Standard Time. This is the opening range that I use to mark out for my break and retest setups right here that you can see. 9:30 a.m. Eastern Standard Time is also a very important time because this is when the stock market opens and it creates big moves in the futures market, which is what we like to trade. The highs and lows of all of these sessions are the liquidity levels that I mark out on my charts. The key thing is that I'm marking out untested levels. So for example, we actually would remove this level because it's been tested, and we would remove this level and mark out this level because this level has not yet been tested. Tested simply means touched, right? So when a level is untested, it just means the price has not yet hit that level. All right, now I'm gonna show you exactly how to mark your levels. This is step by step, so follow along. First, you need to understand all of the sessions. I use this simple indicator called Asian Session Range to mark out my sessions. This indicator is free on TradingView. It's by Rob Minty. If you guys wanna install it, I'll put up a little graphic. To mark these levels, I go right here and I find the horizontal line, and I start by marking out the lows, right? So I start with this untested low, and then I'm gonna mark out this untested low, and then I'm gonna mark out this untested low, and then I'll still mark out this untested low because it's just a really good example of how powerful these levels are, and we'll use that in a second. And then we recently just created all-time highs in the stock market, meaning this is literally the highest we've ever been, so we only have one high. Now, just like I like to color code my candlesticks, I also like to color code my levels. I mark out my lows in blue to show me that this is where I'm looking for buys, and then I mark out my highs in black to show me that this is where I'm looking for sells. Next, I mark out the New York Open. This level is super powerful, and I use it for one of my favorite trading setups. So all you have to do is go on the 15-minute time frame and mark out this first candle at 8 a.m. right here. You mark out the entire candle, and then you're gonna double click on this rectangle and make sure that you have this middle line thing checked, because this midpoint is actually where price usually likes to bounce. Now, once you have all of your levels marked, you just wait. You wait for price to come to one of these levels and you watch for a reaction. And that brings me to my 3 favorite trading setups. Setup 1, the break and retest setup. The break and retest is based entirely on the 8 to 8:15 a.m. Eastern Standard Time opening range box. So the first thing you do is you go on the 15-minute time frame and you mark out this zone like so. You then go down to the smaller time frames, like the 5-minute, and you wait to see what price is doing at 9:30 a.m. Eastern Standard Time. If price is breaking out to the upside of this box, you're looking for a retest, expecting price to continue moving up, right? So I'm gonna draw out a little graphic to represent exactly how this should look. 9:30 a.m. Eastern Standard Time, price breaks up, we get a retest, specifically a retest of this middle line right here, this midpoint. This is very important. This is why I'm staring at the camera. You guys have to look and make sure that you are waiting for a retest of the midpoint, not the top of the zone, not the bottom, the midpoint. We do this because it allows us to place our stop loss right below the zone, giving us some room, and it allows us to just find the best entries, as you guys will see later in the video. So once we get that retest, we are waiting to see some strength on the 5-minute and on the 1-minute, right, which we saw right here. And then we are targeting 15 points with a stop loss of around 5 points, right? In this one, I targeted 16.5 points with a stop loss of 5 points. And on this specific trade, I made around 12 grand. The key thing here is that you are understanding this motion, right? At 9:30 a.m., price is either breaking out to the upside or to the downside, and we are looking for a retest of the midpoint. If we don't get the retest, we will look for some other setups, which I'll go over a little bit later. But if we do get the retest, we take it. I'm gonna show you guys another example of the break and retest setup. So right here, we have my trade that I took on Wednesday. So we're gonna go ahead and mark out the first 15-minute candle from 8 to 8:15 a.m. Eastern Standard Time, just like so. And on Wednesday, I actually took a small loss. So this will be a good example so you guys can see what happens. I took a small loss and then I had a big win. So let's talk about it. So the first trade that I took on Wednesday was a loss. And the reason I took this loss, guys, was purely because I was being impatient. You're supposed to wait until you see this midpoint being respected, and I entered right there. So I just thought, okay, it's gonna bounce right here, and it did bounce a little bit, but then I got stopped out. So then I waited for us to have some respect to the midpoint, meaning candle closures over the midpoint, showing that this is actually a level where price wants to bounce. I entered right there, and I was in zero drawdown, and I caught 16 points, making myself around 10 grand on that trade. So my total profit for the day after this $2,000 loss was $8,000. As always, it's the same simple motion. We are waiting for a break to the upside, a retest of the midpoint, and then a continuation in the same direction that we broke to. And if we broke to the downside, we would simply be looking for this in reverse, right? We'd be looking for a retest like this. And the key thing is, what direction is price breaking to at 9:30, right? Not at 8:05, not at 8:30, at 9:30 a.m. Eastern Standard Time, which direction is price breaking to? We're gonna go over one more example of this setup from yesterday, actually, where I made a lot of money. So let's talk about it. So here's my trade that I took on Friday, everybody. We waited for a break, right? Today we broke it to the upside, retest, respect of the midpoint, meaning no candle closures under the midpoint, right? You can see that price really wants to bounce right there. I entered longs. I caught 16 points with a 5-point stop loss, giving me a risk reward of 1 to 3. And on this trade, I actually sized in pretty heavy, still followed all my rules, and I was able to make $18,000 in a few minutes off of this trade. Keep in mind, I've been trading for around 6 years now, and when I first started, I would make 180 bucks off of a trade, not 18 grand. But if you really stick with the skill and you continue to scale, you continue to be disciplined, great things can happen. So I just showed you guys 3 examples of the break and retest, including a loss, just to keep it transparent, because I show you guys every single trade I took, and I take losses sometimes. That's how trading works. Now we are going to move on to the second type of setup that I look for, which is actually a bounce. This is as simple as it gets, guys. And it's really simple. And the great thing is it actually played out on the same day that I had my break and retest. So we'll use this as an example. So normally what I do is I wait, and if we never get a retest, or if for whatever reason, price just falls through, I will then look for a bounce or look for a rejection. So the first thing I look for is my break and retest. If the break and retest doesn't play out, I look for a bounce, and then I look for a rejection, which I'll go over next. But for now, we're gonna look at the bounce trade. So I'm gonna give you a hypothetical example. Obviously, yesterday I took this break and retest, but if I didn't, the trade that I would have taken would be a bounce off of London low, and you guys can see that this played out perfectly. And you guys can see that this played out to perfection. Bounces are very simple, and it's exactly what it sounds like. If I drop a bouncy ball on my desk like this, it'll come up because the desk is solid. The same thing is true with levels. Obviously, it's not gonna bounce every single time, but when it does bounce, that's the exact same thing that's going on. So I want you to think of these levels almost as like a table and price as a bouncy ball. The faster price falls, the more likely it is to bounce. So when we have a big move down like this to an untested level of liquidity, it's very likely that price is gonna make a good bounce. What I like to do for bounces is I like to go on the 15-minute time frame and mark out my level. I then like to go on the 5-minute time frame and the 1-minute time frame and observe exactly how price is reacting. If price taps this level once on the 1-minute time frame and then immediately comes above it, I like to wait for a few candle closures, and then I like to enter on the 5-minute time frame, which gives me a little bit of confidence that we are going to move back up. So for this trade, I would have entered right here. I would have looked at this and I would have said, okay, at 10:07, we tap this level. Now let's wait for a 5-minute candle closure. So I would have entered right at 10:10, which would have given me a really, really beautiful risk to reward. For bounces, I like to have a 10-point stop loss, and I like to target around 40 points. And we would have caught 40 points, and I would have made a lot of money off of this move. So I just wanted to show you guys that bounce because it happened so recently. Now we're gonna go over a few trade examples that I actually did take on bounces. All right, everyone, so right here you can see that we have an untested New York low, and I took a few trades off of this level. So this is really gonna show you the power of a strong untested level. So right here we have this low, and on Wednesday, and I targeted 40 points like so, and I was able to catch a risk to reward of around 1 to 4. And as always, what I like to do is I like to go down to the smaller time frames, the 1 minute and even the 5 minute. And I like to see, okay, is price showing strength? If price is showing a lot of strength, like it was right here, we tapped this level, but we didn't come above it. I'll wait for a few candle closures above this level, and then I will enter. And I was able to catch 40 points doing that. Now, I just want you guys to observe how powerful this level is. Look how many times we bounced off of this level. 1, 2, which is gonna bring me to my second trade. This is my second trade that I literally took the exact same setup, entered right there, right? Waited for my candle closures, and I caught 40 points. And then I took this setup right here, which I actually got stopped out of because I was a little bit too early on that trade. So that was a small loss, but you can still see that this level is still being respected. It was actually respected 1, 2, 3, 4, 5 times. So I took 2 trades, both of them, or 2 of them were winners, and then 1 of them was a loss. Now that you guys understand bounces, it's time to talk about the final setup that I look for, which is rejections. And the good news is, if you understand bounces, you're going to understand rejections, because rejection is literally the opposite of a bounce. So for rejections, imagine that I'm throwing a bouncy ball at my roof, and the ball immediately is bouncing back down. Literally the opposite of a bounce in every way. So right here, we have an untested New York high, and we are going to trade it the exact same way as we are going to trade a bounce, except we're gonna look for shorts, right? So we are looking for price to have a bearish rejection, and ideally, we want to see price tap this level and fail to close over it, right? So we saw price tap this level on the 15 minute. So if we go to the 5 minute, we can also see that price was failing to have any candle closures over this level on the 5 minute. So that would have given me enough confirmation to look for some shorts right around here with a 10-point stop targeting 40 points. And this trade would have played out beautifully. We honestly could have targeted even more points, but for the sake of the video, we targeted 40 points and we caught a 1 to 4 risk to reward ratio. That's the way I trade. I like to target either 1 to 3 or 1 to 4. So that is how you trade rejections, everybody. All right, so now we have an untested London high, and we have price approaching this high. So what we're gonna do is we're gonna go down to the 5 minute time frame. We're on the 5 minute time frame already, actually. We can see that price is failing to close above this level. So we actually would have taken shorts when we got that second retest after a complete fail of this level. Right there, 10-point stop. Let's go ahead and target our 40-point move, like so. And boom, that was another beautiful trade that I took a while back, and it played out quite nicely, played out very nicely. So those are the 3 setups that I trade every single day, guys. The break and retest, bounces, and rejections. And they all work because they're based on where liquidity is. We're not predicting the market, we're following the money. All right, so now you understand the strategy. You understand how it works, why it works, and how to trade it manually. But here's the real question. Why would you want to automate it? The answer is very simple, because automation gives you freedom. When I was trading the strategy manually, I was profitable. I was making quite a bit of money, but I was also stuck at my desk all day. I could not miss a session. I could not take a day off, because if I wasn't watching, I was literally going to miss setups. But once I automated it, everything changed. Now, the algorithm trades for me 24/7. It never sleeps, it never gets tired, it never gets emotional. It just executes the strategy perfectly every single time. And I get to actually live my life. I wake up, I check the performance, and then I go do whatever I want. I'm not chained to my desk anymore. This is the power of automation, and this is why every institution uses algorithms, because they understand that humans are the weakest link in the system. If you have a profitable strategy and you can remove the human element, you now have a machine working for you inside of your account while you sleep. Here's something super important that most traders don't realize. Automation doesn't just save you time, it solves a much bigger problem. And that problem is, how do you actually know if your strategy is profitable or not? When you're trading manually, you might take 20 trades over a month. You win some, you lose some, but is that enough data to know if your strategy actually works? No, You need thousands of trades, like actually thousands of trades, to know if a strategy is truly profitable over the long term. And that's where backtesting comes in. Backtesting is when you test your strategy on years of historical data to see how it would have performed. This gives you thousands of data points and tells you whether your strategy has a real edge or not. In other words, is your strategy profitable or is it not? Let me show you an example of exactly what I'm talking about. So let's go into the indicators tab and let's pull up one of the most popular strategies, the MACD strategy. So if we go right here, we can actually go into the code, and I'm not gonna bore you guys with what's going on. It's very simple. We are pretty much buying when price goes over the MACD and selling when it goes under it. So pretty simple, right? So now what we can do is we can actually go into the back test of this strategy and we can see how it's performing. Not very good. We can see that this is 35% profitable, and over the last 4 years, it's lost 2%. So it's just not making money. You can see it at a quick period of making money, but this is clearly an unprofitable strategy. And we have 1,700 trades or 1,800 trades pretty much. So that's enough data to show us that this strategy is just not good, not working, not profitable, not good. But here's the thing, right? The reason I'm showing you guys this is because if you guys were trading this manually, which a lot of you probably are, you might not even realize that it's a losing strategy until you've already blown your account because you don't have enough data. Backtesting tells you the truth. It shows you whether a strategy actually works or not. And this is why automation is so powerful, because you can't automate a strategy without backtesting it first. So the first step to automation is proving that your strategy is actually profitable. And the way to do that is with a backtest. Your backtest, if your strategy is profitable, should ideally look like just a big green line that goes up over time. Now let me show you how you can use AI to build and test strategies. This is the future of trading, and it's incredibly powerful. I'm going to use a tool in this video called Manus AI. This is an AI assistant that can code strategies for you in PineScript, which is the coding language for TradingView. So let's get into it. Watch this, guys. I'm gonna ask Manus to code a very simple support and resistance PineScript strategy for me. Code a simple support and resistance PineScript trading strategy for me. Let's see, right? So obviously, this might take like 3 or 4 minutes, so I will fast forward and I'll come back when we have a full strategy built, and then I will test the strategy and we'll see how it performs. You can see that Manus is doing all the thinking. This stuff is truly incredible technology, guys. It's almost done with the file, so let's see how this performs. The reason I did support and resistance is because that's what most retail traders are trading, so let's see if it's profitable or not. All right, everybody, so here I have a simple strategy that Manus coded. I will admit, coding your own strategies is definitely not easy, especially if you're not super familiar with coding, but there's a strategy. For the sake of this video, I'm not gonna go into backtesting and doing all of it, but I just wanted to show you guys that if you wanna code your own strategies, you can do that. All right, so if you wanna automate your trading, you guys have 3 paths. The first path is to build your own algorithm from scratch. This is what I did. I hired a team of developers and we spent 2 years building a suite of algorithms. This is the most expensive and time-consuming option. You're looking at $25,000 to potentially even hundreds of thousands or even $1 million or more in development costs just to build a profitable algorithm. This path is great for people who already have a profitable strategy, have a lot of money, a lot of time, and have a specific vision for what they want to build. Luckily, I fall into that category. Path 2. Use AI to help you build and test strategies. This is what I just showed you with Manus. You can use AI to code strategies, backtest them, and iterate quickly. This is cheaper than hiring developers, but it's still time consuming and it's not easy. You're gonna spend weeks, and honestly, you're gonna spend months and months testing different ideas and fine tuning and getting through all the errors as we just saw here. This path is great for people who are technically inclined, good at coding, and who actually enjoy the process of building algorithms. Path 3, use a proven, pre-built algorithm. This is the easiest and fastest path. You find an algorithm that's already been built, tested, and proven to be profitable, and you deploy it in your account. You don't have to code anything, you don't have to backtest anything, you don't have to spend months testing ideas. You just deploy the algorithm, and the algorithm starts trading in your account. And this is the path that I recommend if you're serious about algorithmic trading. Because here's the reality, guys. Building a profitable algorithm is hard. It takes time, it takes expertise, and it takes a lot of trial and error. But using a proven algorithm, that's simple. You just deploy it and let it work inside of your account. And that is exactly what I have built. All right, so now let me show you the 3 algorithms that I've built. These are based on the exact strategy that I just taught you earlier in this video, the liquidity strategy that I learned from my godfather at Goldman Sachs. Each of these algorithms have been backtested over thousands and thousands of trades, as you can see, And they're all currently running on live funded accounts, and I'll do a live broker login to show you all the results. Let me walk you through each one. The first bot that I'm going to show you is our ES scalping bot. This bot is one of my favorite bots because it trades very similar to the way that I trade. You all can see that this bot is extremely profitable over the last 4 years. This is a full back test, over 3,134 trades. And the important thing to know is that we start right here, right? And we end up over here, showing that even though we take losses, we are consistently profitable because we have a good risk to reward ratio. Now, to go over some of the setups that this bot took, we can see that we took shorts right there, and we were able to catch 30 points. And then on our second take profit, we were able to catch almost 50 points. So we took shorts, got 30 points on our first take profit, and then on our second take profit, we caught 50 points. And then we actually entered longs right there, took profit, and we entered some shorts right there, took profit from our shorts right here, and then we took a bunch of trades on this day. And now another beautiful setup that we caught right here, which is actually around one of the untested London lows. We entered right there, entered longs, and then we got out of our longs right here for 30 points. Then recently you can see that the bot had a small loss right there, but then we recovered immediately with a beautiful win of around, I want to say 20 points off of this trade. Yep, 20 points. Took some shorts right there, got out right there. On that specific trade, we were able to catch nothing crazy, around 10 points. And then recently, on our last day, we had 3 back-to-back winners. We caught 15 points there. And then on this trade, we were able to catch 12 points. And then on this trade, we were able to catch 10 points. So yeah, really, really cool stuff, guys. So if I go through the wins and the losses, you guys can see that we are having small losses and then nice big winners. That's really what matters when we're trading. All right, everyone. So this is our prop firm scalping bot. This bot trades similar to the first bot that I just showed you, but it trades on the 5-minute time frame and it trades NQ. We like to have some bots that trade ES, some that trade NQ, just to allow our clients maximum options. And yeah, so this bot, instead of trading on the 1-minute time frame, it trades on the 5-minute time frame. You can see that it's taking some shorts right there. Up here, took some longs, took profit. Right here, got some shorts, got out right there. And yeah, this bot is a scalping bot. So we took some longs right there, took profit there. And yeah, now to show you guys the back test, you can see that over 5 years, we've won 80% of the trades and we're obviously profitable. We will go through some periods of drawdown. That's just how the markets work. That's how trading works. But yeah, this is a great bot, and this is specifically meant for people who are trying to pass prop firm challenges. All right, now we are on our final algorithm, and this algorithm is really cool. This algorithm is obviously profitable. You guys can see the back test over the last 5 years since 2021. As always, we'll go through short little periods of drawdown, but we're consistently profitable over 5 years, so that's what matters. This bot is a little bit different than the other bot. So this bot still uses the same logic, but it trades on the 1-hour time frame, right? So this bot is a little bit more of a swing bot, although it usually stays in trades between like 1 through 5 hours. Every now and then it'll hold a trade overnight, but usually it's out in the same day. So right here, we took some longs, got out of the longs right there, took some longs right there, got out there, had a small loss right there, a few small losses. Then we took some more longs and we caught some beautiful shorts right here. Then we got out right there, caught some longs. One of the reasons I love this bot is because it's really good at following trends. So right here, you can see that we almost caught pretty much the entire move up, got some longs right there, took profit there, longs right here, which was a beautiful play, literally entered right before we had this big move up, took profit right there, catching longs all the way up. And yeah, really, really cool bot. And as always, if I go into the list of trades, you can see that we're having nice big winners, 2,500, then we have the small loss, 1,400, 875, 4,600, 4,500, 3,000, 5,000, 1,700, 3,000, negative 1,400, $6,000 win. So yeah, pretty clear to see that this is a profitable strategy. So these are the 3 algorithms. Each one serves a different purpose, but they're all built on the same institutional principles that I learned from my godfather. And they all trade automatically 24/7 without me having to do anything. Now, I don't want you to just take my word for it. Let me show you what these algorithms have done for our clients. All right, everybody, so this is the profit section of our Discord. This is a live chat where people are able to share their results for the day. So let's go through it, right? This is literally just over the last 3 days. If I wanted to show you all the results from the month, we'd literally be here for hours and hours, but here we go. So my man CJ, who recently joined, and his thing is he's trading with a lot of funded accounts. So he's trading just with a lot of capital behind him, and he was able to make $4,500, or actually way more than that. That's just on one bot or on one section of accounts. So he was able to make $7,500 in a day from PropBot. He said that he loves it. He texted me this picture actually, and then he also posted it in the profits chat, which is cool to see. And then we have my man Lewis. He's using a much smaller account, but he still made $265, which is awesome. My man Thomas said that he made $1,200. He's calling it Prop Goat instead of Prop Bot, so he's obviously a huge fan of the tech. And Zach said that he's desperate and he would have been in red if not for the algo. So it's really cool to see. It's cool to see people who are manually trading but still allowing the algos to, do some of the heavy lifting, because he said that the algorithm kind of saved his day. Now, this is Shay, right? Shay is an awesome guy. The thing with Shay is he was just very inconsistent with executing his strategy. Super smart dude, does really well for himself financially, but he was just struggling with consistency. So he said that now that he's secured a bunch of payouts on his funded accounts from the algorithm, he's now focused on scaling it up. So what he's doing is he's taking his payout of $5,000 and he's reinvesting it all into more prop firm challenges. So next time he gets a payout, it's gonna be way bigger and he's gonna make a lot more money. My man Slingblade says he's using 10 micros on PropBot. He said it's green, $860 on the week. So I'll scroll down to Friday in a second, but right here you can see that my man, the Z-Lap, is also cashing in on the algorithms. Tyler is as well, he's loving them. He said, thank you RP for the bots. PropBot had a bunch of clean trades yesterday. So yeah, people are loving the algorithms. People are loving the algorithms, guys. Right here is another beautiful win. Slingblade came back and updated us. He said he's updated everybody on Friday. He said he finished up $1,240 on the week with 10 micros, which is really cool to see. So yeah, guys, clients are absolutely loving the algorithms. Now let me show you the ultimate proof. I'm going to do a live broker login and show you exactly how these algorithms are running on real funded accounts. So you all can see that they're performing great. I'm gonna go ahead and take a second and generate some reports to show you guys how these algorithms are performing over the last few days, last few weeks, so you guys can check out all the results. Everything is here, and yeah, we're doing great, right? This is obviously a Tradeovate account hooked up to my Apex account. So here's some of the trade history. Here's some of the trades we're taking, some of the results. You guys can, take a second, pause the video, look through, whatever you want to do. All right, so now you have a decision to make. You have 3 paths forward. First path is that you stay a manual trader. You can keep doing what you're doing. You can sit at your desk all day, manually clicking buy and sell, dealing with emotions, missing setups, and struggling to be consistent. And here's the reality. Most manual traders never make it. They blow their account, they get frustrated, and then they quit. Even if you do make it, you're gonna be chained to your desk. You're gonna have no life, and you're going to be stuck. This is the path of the broke, stuck manual trader. Path 2 is that you become a strategy tinkerer. You can try to build your own algorithms. You can spend months or years testing different ideas, tweaking parameters, and trying to find something that works. And here's the reality. Most people who go down this path never finish. They get stuck in analysis paralysis. They keep testing and tweaking, and they never actually deploy anything. And even if you do build something, you don't have the resources that institutions or somebody who's extremely wealthy has. You don't have a team of Goldman Sachs developers. You don't have years of institutional knowledge. You are trying to compete with institutions using retail tools, and to be honest, that's an uphill battle. This is the path of the strategy tinkerer who never actually makes money. Path 3, leverage proven technology. You can use a system that's already been built, tested, and proven to work. You can deploy it in your account and you can start making money immediately. You don't have to spend years learning. You don't have to spend months testing. You don't have to sit at your desk all day. You just deploy the system and the system works for you. This is the path of the smart trader who leverages technology to win. And this is the path that I would recommend, because here's the reality. The institutions have been using algorithms for decades. They have teams of developers, they have billions of dollars in resources, and they have years and years of data. You are not going to beat them by manually trading, and you're probably not going to beat them by building your own algorithm from scratch. But you can compete with them by using proven, institutional grade technology. And that's exactly what we've built. So here's what I want you to do. If you're serious about algorithmic trading, if you want to stop being chained to your desk, and if you want to start making consistent income without the stress of emotions, then I invite you to book a call with me and my team. We are going to show you exactly how our systems work. We'll show you the full back tests, the live results, the client testimonials, and we're going to show you exactly how you can deploy these systems in your own broker or funded account. There's a link in the description, so click that link, book a call, and let's have a conversation. Now, I'm not going to sit here and tell you that this is for everyone. It's not. This is for people who are serious, and this is for people who are willing to invest in themselves and their future. So if that's you, and if you're ready to take that next step, then book a call, let's talk. I've given you everything you need in this video, the strategy, the principles, the framework. But if you want that done for you solution, if you want the proven systems that are already doing well, then book a call and let's build that freedom together. Thank you all for watching. Have a great day.